Is the global economy heading towards another financial crisis? The warning signs are clear, the banking fire is sparking, and we need to be cautious. Hello and welcome to this video on why the banking sector is causing concerns of another global financial crisis. Recent news of bank failures, such as SVB and Credit Suisse, have once again brought the spotlight back on the potential of another global financial crisis. While the banking industry has undergone significant regulatory reforms since the 2008 crisis, there are still several factors that can trigger another financial crisis. In this video, we will explore the reasons behind these concerns, the potential consequences of another financial crisis, and what can be done to prevent it from happening. Reasons behind the concern. Firstly, let's take a look at some of the reasons that are causing concerns of another global financial crisis. Number 1. Rise in non-performing assets. Non-performing assets are loans that borrowers have failed to repay. The global pandemic has caused a significant increase in NPAs, and banks have been forced to increase their provisions to cover these losses. This has affected the balance sheets of banks and their profitability. According to the Reserve Bank of India, the gross NPA ratio of banks is expected to increase from 6.5% in September 2022 to 9.4% by September 2023. The rise in NPAs has not only affected the banking industry, but also the overall economy, as it restricts banks' ability to lend and slows down economic growth. Therefore, addressing the issue of rising NPAs is crucial for ensuring the stability of the banking industry and the global economy. Number 2. Low interest rates. Central banks around the world have been keeping interest rates at historic lows to boost economic growth. While this has helped to stimulate the economy, it has put pressure on the profitability of banks. Banks make money by lending at higher rates than they borrow, but with low interest rates, their margins have been squeezed. In addition, low interest rates have also increased the demand for loans, leading to increased competition among banks to offer attractive interest rates to customers. This has further added to the pressure on bank profitability. The low interest rate environment has also encouraged companies and individuals to take on more debt, which could become a problem if interest rates rise or if there is a slowdown in economic growth. Therefore, managing the impact of low interest rates is crucial for ensuring the stability of the banking industry and the global economy. Number 3. Cybersecurity risks. As banking becomes increasingly digitalized, cybersecurity risks have become a growing concern for the industry. Cyber attacks targeting banks can cause significant financial losses and damage to the reputation of the banks. Hackers can steal sensitive customer data, disrupt banking services, and even gain access to bank accounts. With the shift to remote working during the pandemic, there has been an increase in cyber attacks, and banks have had to invest heavily in cybersecurity measures. However, cyber criminals are becoming more sophisticated, and it is becoming more challenging to detect and prevent cyber attacks. Therefore, it is crucial for banks to continue investing in cybersecurity measures and for governments to implement regulations and standards to protect against cyber threats. Managing cybersecurity risks is essential for ensuring the stability of the banking industry and maintaining customer trust. Number 4. Increasing debt. Over the past few years, global debt has been on the rise, with governments, companies, and individuals taking on more debt. This trend has been exacerbated by the pandemic, with governments borrowing heavily to support their economies and companies and individuals taking on debt to weather the economic downturn. The increasing debt levels have raised concerns about the ability of borrowers to repay their debts, which could lead to defaults and financial instability. High levels of debt also limit the ability of central banks to respond to economic downturns with monetary policy measures such as interest rate cuts. Therefore, addressing the issue of increasing debt is crucial for ensuring the stability of the banking industry and the global economy. This requires a coordinated effort by governments, central banks, and other stakeholders to manage debt levels and promote responsible borrowing. Number 5. Over-reliance on central banks. Since the 2008 financial crisis, central banks have played a critical role in supporting the global economy through their monetary policies. However, over-reliance on central banks has become a growing concern. Central banks have been keeping interest rates low and buying up government bonds to stimulate the economy. This has resulted in a large expansion of central bank balance sheets and raised concerns about the effectiveness of their policies in the long term. There is also a risk that central banks may become too closely linked to governments and lose their independence, leading to inflationary pressures. Therefore, it is crucial for governments to take on a more significant role in supporting the economy and for central banks to carefully consider the long-term implications of their policies. Over-reliance on central banks is a risk to the stability of the banking industry and the global economy. Avoiding a financial crisis. While the concerns about a banking crisis are real, steps can be taken to avoid it. Number 1. Diversification. Diversification is a critical strategy for banks to manage risks and avoid a financial crisis. By diversifying their portfolios across various industries, regions, and asset classes, banks can reduce their exposure to specific risks and avoid over-concentration in any one area. Diversification can also help banks to take advantage of opportunities in different markets and generate more stable returns over the long term. However, diversification must be done carefully to avoid spreading risks across different areas and becoming vulnerable to broader economic shocks. Therefore, banks need to carefully assess the risks and benefits of diversification and develop a diversified portfolio that balances risk and return. Diversification is an essential tool for ensuring the stability of the banking industry and avoiding a financial crisis. Number 2. Improved risk management. Effective risk management is crucial for avoiding a financial crisis in the banking industry. Banks need to identify and assess potential risks and implement strategies to mitigate them. This requires a robust risk management framework that includes policies, procedures, and controls for identifying, measuring, monitoring, and managing risks. Banks must also have a risk culture that emphasizes the importance of risk management and encourages proactive risk management practices. Improving risk management requires continuous investment in technology, data analytics, and risk management expertise. Banks also need to incorporate emerging risks such as cybersecurity and climate change into their risk management framework. By improving risk management practices, banks can reduce the likelihood of a financial crisis and build a more resilient banking industry. Effective risk management is an essential tool for ensuring the stability of the banking industry and avoiding a financial crisis. Number 3. Maintaining healthy cash reserves. Maintaining healthy cash reserves is an important strategy for avoiding a financial crisis in the banking industry. Cash reserves act as a buffer against unexpected losses or liquidity shocks, such as a sudden increase in withdrawals by depositors. Banks must maintain sufficient cash reserves to meet their obligations, such as paying out deposits or honoring loan commitments, even during times of financial stress. Maintaining healthy reserves requires careful management of the bank balance sheet and liquidity risk. Banks must also assess their cash needs in relation to their lending and investment activities and ensure that they have adequate sources of funding to support their operations. By maintaining healthy cash reserves, banks can avoid the need for government bailouts or emergency funding during times of crisis and ensure the stability of the banking industry. Number 4. Regulatory reforms. Regulatory reforms are crucial for avoiding a financial crisis in the banking industry. Following the 2008 financial crisis, regulators have implemented a range of reforms aimed at improving the stability of the banking industry. These include higher capital and liquidity requirements, stress testing, and the creation of resolution frameworks for dealing with failing banks. Regulatory reforms have also focused on improving transparency and reducing systemic risks, such as through the implementation of central clearing for derivatives. In conclusion, the potential for a banking fire to spark another global financial crisis is a real and pressing concern for many experts. The increasing interconnectedness of the global financial system, the use of complex financial instruments, and the high level of debt in the global economy all contribute to this potential risk. However, by taking steps to diversify our investments, maintain healthy cash reserves, and stay informed about the latest developments, we can better protect ourselves from the potential fallout. I hope you found this video informative and helpful. If you have any questions or comments, please leave them in the comments section below. And don't forget to like and subscribe to our channel for more informative videos like this one. Thank you for watching and Stay safe in these uncertain times.